Hey everyone, welcome back to the channel. Today we're diving into a question that a lot of investors ask. Should I invest in the NASDAQ 100 or the S&P 500? Both of these indices are giants in the world of investing, but they're built differently, behave differently, and can have very different impacts on your portfolio. So, by the end of this video, you'll have a clear understanding of what sets them apart, how they perform, and which one might be the best fit for your investment goals. Let's get started. So, what's the difference between the NASDAQ 100 and the S&P 500? First, the NASDAQ 100. This index tracks the 100 largest non-financial companies listed on the NASDAQ stock exchange. It's very tech-heavy, which means most of the companies you'll see here are from sectors like technology, biotechnology, telecommunications, and consumer services. Companies like Apple, Microsoft, Amazon, and Alphabet dominate this index. In fact, technology alone makes up over 50% of the NASDAQ 100. So when you invest in it, you're essentially betting big on the future of tech and innovation. On the other hand, we have the S&P 500. This is a broader, more diversified index that tracks 500 of the largest publicly traded companies in the United States. It covers a wide range of sectors: technology, healthcare, financials, consumer discretionary, and more. While tech still has a significant presence in the S&P 500, making up about 28%, you're also getting exposure to industries like healthcare, energy, and utilities, which balances out the risk. Now, let's talk about performance and behavior. The NASDAQ 100 tends to be more volatile. Since it's heavily focused on technology and high-growth companies, it can deliver incredible returns during bull markets, but that also means it can drop just as quickly during downturns. Over the last decade, the NASDAQ 100 has significantly outperformed the S&P 500, with annualized returns of around 18 to 20%. But that growth comes with higher risk, and when the tech sector faces a pullback, the NASDAQ feels it hard. The S&P 500, on the other hand, is more stable. Because it's diversified across 11 different sectors, it doesn't experience the same extreme highs and lows as the NASDAQ 100. Historically, the S&P 500 has delivered solid, long-term returns of about 10 to 12% annually. It's more resilient during market downturns because not all sectors decline at the same time, which provides a cushion during recessions or economic slowdowns. So, how should you approach investing in these indices? If you're someone who's comfortable taking on more risk for the potential of higher returns, the NASDAQ 100 might be the right fit for you. It's a great option for growth-oriented investors who believe in the long-term dominance of technology and innovation. But keep in mind that this comes with more volatility, so it's best suited for those with a longer time horizon who can ride out the ups and downs. On the flip side, if you're looking for a more balanced and steady investment, the S&P 500 is a solid choice. It's ideal for conservative or moderate investors who want consistent long-term returns. Plus, it's a great option for retirement portfolios or anyone looking for a reliable core holding that reflects the overall United States economy. Let's talk strategy. For the NASDAQ 100, a long-term buy and hold approach is often the best strategy. Because the index is so focused on growth sectors, holding it for 5 to 10 years or longer can give you exposure to tech innovation that compounds over time. Some investors also use sector rotation strategies, shifting their investments between tech, healthcare, and communications based on market conditions. And for those looking to take on even more risk, leveraged ETFs like TQQQ can amplify gains, but be careful because they can also magnify losses. With the S&P 500, it's all about steady growth and consistency. Many investors use the S&P 500 as the foundation of their portfolio, complementing it with other asset classes to diversify even further. A popular strategy here is dollar cost averaging, investing a fixed amount of money at regular intervals. This helps reduce the impact of market volatility by spreading out your investment over time. And if you're focused on generating income, you can also target dividend-paying companies within the S&P 500 for consistent returns. Now, who should invest in each of these? The NASDAQ 100 is perfect for those who want to chase high returns, and are comfortable with higher volatility. Younger investors, in particular, who have a longer time horizon, can benefit from the growth potential of tech-heavy investments. If you're a believer in the future of AI, cloud computing, and e-commerce, the NASDAQ 100 aligns with that vision. The S&P 500, however, is better suited for conservative investors, retirees, or anyone who prefers a more balanced approach. It's a go-to option for those who want to grow their wealth steadily over time without taking on too much risk. It's also a great choice for building a core portfolio that can weather economic downturns and still deliver solid returns. But what about the risks? The NASDAQ 100's biggest risk is sector concentration. When you put most of your eggs in the tech basket, you're more vulnerable to downturns in that sector. And with high valuations for many tech companies, there's also the risk of a sharp correction. Plus, increased regulatory scrutiny on big tech could affect long-term performance. The S&P 500, while more diversified, isn't immune to risks either. It's more sensitive to overall economic conditions, so during broad economic downturns, the entire index can take a hit. And while its growth is steady, it's slower compared to the explosive potential of the NASDAQ 100. So, which one is right for you? If you're all about growth and don't mind taking on more risk, the NASDAQ 100 can give you the high returns you're after. But if you prefer a more stable and balanced approach, the S&P 500 offers consistent returns that can help you build wealth over time. And here's a pro tip. You don't have to choose just one. Many investors use a combination of both. A 60-40 or 70-30 split between the S&P 500 and NASDAQ 100 can provide a balance of growth and stability, allowing you to benefit from tech innovation while maintaining a diversified core. That's it for today's deep dive into the NASDAQ 100 versus the S&P 500. If you found this video helpful, don't forget to hit that like button and subscribe for more investing insights. And if you have any questions or want to share your thoughts on which index you prefer, drop them in the comments below. I'd love to hear from you. Until next time, happy investing.